U.S. natural gas futures retreated on Tuesday as traders took profits following Monday's weather-driven surge. The May contract, which had gained nearly 20 cents over the past two sessions on cooler forecasts and robust LNG demand, lost momentum after a shift toward warmer trends in the last 24 hours. The latest HDD data indicates moderate demand over the next 7 days, but a lighter outlook for the 8 to 15-day period due to the recent warming trend. Reinforcing the bearish sentiment, dry gas production on Monday reached 107.1 billion cubic feet per day, marking a 4% increase year over year, while demand slipped to 74.2 billion cubic feet per day, down 1% from the same period last year. Meanwhile, electricity demand remained steady, with lower 48 generation rising 0.9% year over year for the week ending March 22. Meanwhile, the storage deficit continues to narrow, with a decrease from 122 to 68 billion cubic feet anticipated over the next 4 weeks. This gradual reduction suggests a steady improvement in storage levels, which could provide some relief to market conditions as the gap between supply and demand tightens. Technically, just one bullish factor remains: the recent decision to lift the U.S. pause on LNG export project approvals. This policy shift is expected to accelerate the expansion of LNG export capacity, which could gradually tighten domestic supply. However, the actual impact will hinge on whether production keeps rising or starts to plateau. With prices already elevated, there's little doubt that gas companies will push to ramp up output significantly. Technically, the short-term trend is still pointing downward, but last week saw the emergence of bullish momentum following a closing price reversal on March 27. Monday's gap higher briefly pushed prices to a one-week high, but the rally lost steam just under the 50% retracement level of $4.25, prompting some profit-taking. Key support levels to watch include the 50-day moving average at $3.88 and a minor pivot at $3.80, which remains a crucial level for the bulls to defend. It seems the bulls are struggling to maintain prices above the $4 resistance for more than just a couple of days, which is raising some red flags. If the market sustains a move below $4, it could signal mounting selling pressure, potentially speeding up a decline toward the longer-term pivot at $3.50. This would certainly put the bulls on edge, as a break below that level could trigger even more downward momentum. Please like, subscribe, and comment to support the channel. See you in the next one.